I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. It's been in business for 55 years, delivering investment advice to individual investors. Um, Brad, I watched a little bit of your team last night, Arizona Cardinals. They do still exist.
Oh,
Standalone game. Did you watch any of that? Sounded
yeah, I
like
watched that game.
okay. Marvin Harrison Jr. is on my fantasy team. He's been a bit of a disappointment. That was the main reason I was watching, but I have no comments. I have no comments on it. It was about as I expected, I guess.
Yeah, they're not great.
Yeah.
They have three good quarters in football in them as a team collectively.
Yeah.
You never know when they will put those quarters together, and they're not really enough to win meaningful games on a regular basis. I mean, they sort of collapsed against Carolina. Obviously, they were doing really well against the Niners, and then sort of fell apart, and then tried to engineer a comeback that fell short. They'll be a
Are they 0 and
fine.
3? I don't even know.
No, they're 2-2.
I mean, sorry, that's the fourth. That's right, the fourth game. Who did they beat?
Uh, who did they play in the first week? Oh man. Oh, they beat New Orleans.
Oh, okay.
So they beat New Orleans, beat Carolina, lost to San Fran,
Okay.
lost to Seattle. They're not going to be a great team. I like Kyler is not big enough to throw over giant offensive linemen and defensive linemen. Too many passes get swatted. He's
Yeah.
always scrambling. I don't think he sees his exit routes really well. And like I was one of the guys who was like, no, it doesn't matter that he's not that tall. But the fact that he's like my height or maybe like marginally taller than me makes it
Yeah.
really tough to play football in the NFL, especially without like a top tier offensive line.
Yeah. I did think Marvin Harrison was gonna be better. He was a stud coming out of Ohio State, but yeah. Uh, he got a few points at the end for me, but he hasn't. He's been underwhelming, I guess.
Yeah, my
Um,
fantasy team is not doing great.
yeah.
Like
All right. I'm
I'll
sure
be
it
I'll
was.
be 1-3 at the end of this week.
Well, as much as people probably care about our fantasy teams,
Yeah.
let's move on to investing. Let's tell people what we're going to talk about this week.
We are going to talk about the market pullback that we went through, have been going through, depending on how today closes. We'll talk about IPO market heating up a little bit, small caps outperforming, Nvidia investing in Intel, and then Intel also going sort of hand in hand to Apple and Taiwan Semi. And we'll also talk about investing in a world where the government is picking winners and losers.
But before all that, as always, we have Defend the Take, and you're up this week, Brad. And your take, for which you have 90 seconds to defend yourself, is that the bond market is going to be a problem. Again, you have 90 seconds. Go.
All right. So Fed obviously cut rates on the 17th, right? So like a week and a couple of days ago. 10-year yields dipped leading into that, but have since rebounded. They got as low as like 4%. They're up to like 4.18% as of this recording. Um, the problem, insofar as it's presented by the bond market, is that the bond market doesn't buy that rates are going to zero really quickly. If you looked at the Fed summary of economic projections, they had the Fed funds rate around 3% by year end 2028. That is 3 years from now. They also had growth sub 2% for the next 3 years of their longer run projections, and unemployment staying sort of below 4.5% for the next 3 years as well. The picture that it's painting right now, the way the bond market is trading, is no catastrophe, no rapid rate cuts, but also meaningfully slower growth, or at least growth that's sort of bottled up. Where that's a problem for investors is, and we'll talk about this with small caps a little bit, I'm sure. Um, Small caps tend to thrive in low rate environments, and it doesn't seem like that's coming. It's going to be difficult for homeowners. The 30-year mortgage tends to be in the neighborhood of 2.5 to 4% above the Fed funds rate. It's more closely indexed to the 10-year, but the 10-year also sort of responds to rate pressures as well.
Time.
So we're probably looking at mortgage rates 5-6% for the next 3 years. Growth's going to be slower. It's going to be tough.
3 years. Yeah, that's depressing sounding.
I mean, like the problem obviously is and we'll get to the government picking winners and losers is I mean, I guess once you have enough Fed governors on board, you can just say, no, interest rates are zero. And then that throws a wrench in the works. And maybe things like drastically change. But for the time being, we just have a lot of economic policies that are drags on growth. They don't make the pie bigger so much as they rearrange money. And the bond market is respecting that in a way that the stock market has not been the last nine
Right.
months.
Right. Well, let's transit. That's a good transition to what is happening in the stock market right now. From an index perspective, there's been a pullback this week. Three straight down days prior to today. It looks like Friday looks like it's going to bounce back a bit. Well, actually, we'll see. It could go either way. But as a whole, market's down like 1% from all-time highs that it hit on this Monday. Um, but under the surface, there's some cracks, as Mike likes to call them. More than half the stocks, or excuse me, there are more stocks hitting 52-week lows than 52-week highs, which is a big departure from the last couple months, really. Um, and it's about 50-50 in terms of stocks above and below their 50-day moving averages. So there's some weakness under the surface. Now, there's been some sort of false starts or false ends, starts to beginning of the ends. I don't know how I'd phrase that. Um, some false market pullbacks, I guess, in the last month or two. Especially first couple days of September. You're like, oh, here we go. Here's the normal 5% market pullback that we always get in September. Possible it was delayed a few weeks just because in anticipation of the Fed cutting rates. Maybe it was a buy the rumor, sell the news, a classic buy the rumor, sell the news type of thing that's happening. I don't know, or maybe it's just the fact that valuations are super high. We've been talking about how the market sort of price per perfection is due for at least a short-term pullback. What do you see? What do you think's happening? Do you think we'll get some meaningful pullback in the actual indexes, or do you think there's sort of another, false pullback?
I, I do think that I think we'll see some pullbacks, but I don't think it's going to be catastrophe. I don't think we'll get a
No,
repeat of
no.
of April. There's just there's less upside left.
Yeah,
SP 500 as a whole hit a PE ratio of 30. That's historically bad news.
yeah.
Um,
On a
the
trailing basis, right? Trailing.
yes,
Yeah.
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 The
I was going to mention forward PE. It's like 23.6, 23.7, which is the highest since February, which was the previous peak before that, the April pullback that you mentioned. But go ahead.
one of the, I mean, obviously the big driver is AI, energy, all those sort of interrelated sectors. There are a lot of people that are sort of questioning how circular the AI rally is and a greater willingness to take profits. I mean, we've seen that with Oracle for the
Mhm.
last, what, 10 days or so. Just looking real quick, in the last week, Oracle is down 7.5%. They're still up 22% in the last month, right? They rallied
Yeah.
really strongly on the investment news, but increasingly analysts are looking at this and saying, okay, well, where's the money coming from and what's it turning into? Because Nvidia is funding OpenAI. OpenAI is committing to buy capital from Oracle. And then Oracle says that they're going to lease back chips. They're going to lease chips or buy chips from Nvidia. And just sloshing money around in like a circular AI economy doesn't lead to gains. You need productivity growth, you need improved profitability, and people are starting to sort of question where that is ultimately going to come from. Um, and like while that happens, consumers are paying the price. They're paying higher rates for electricity. We're still seeing inflation a little bit higher than we would like to be seeing it, right? It was like what PCE was 2.9 today and core was
Yeah.
2.7.
Yeah. It was, I think on a headline basis, it was the highest since like February or something. I think that it came in line with expectations, though. I
Yeah.
think. Yeah.
So if the biggest driver in the market of the bull market for the last 2 years, which has been AI, is running out of steam, and I don't think it's collapsing. I do think we're just seeing it run out of steam. Um, where is the growth coming from? Consumers are resilient, but they're not driving a ton of excess spending. They're starting to dip into savings to pay for the higher inflation. The personal savings rate dipped from 4.8 to 4.6%. Wage growth year over year was like, or what? Wage growth was 0.4%.
Yep.
So where's the engine for this vehicle, right? Where's the growth engine? And right
Hmm.
now, I don't know that there really is one. Um, I think maybe we get one, and we'll talk about that more with the sort of winners and losers picture of it. But for the time being, I think the market is tired. It needs a breather.
Yeah.
Um, we'll see.
Yeah. I mean, it still does have the reason I think that the bull market is not going to collapse anytime soon is that AI is just this giant tailwind at the market's back, and it's fueled corporate earnings. Reached double-digit growth in what, two, three straight quarters. We'll see what happens in October. Well, it'll be this upcoming earnings season could be pretty interesting. I mean, I feel like, but yes, things are overextended, and I think tired is a good. I think you used that word. That's a good word for what's happening right now. I could see, I think I had to defend the take maybe a month or so ago, saying that I thought that the market was going to pull back at least 5%, with the bottom coming in October. Um, I guess I'm going to hold to that, partly just out of being stubborn, but also because there's the reasons I think that are have not gone away. Market has been priced for perfection. Um, and we don't have, until earnings season starts in a few weeks, we don't really have uh, an obvious catalyst, other than AI is exhausted in the short term. I think AI will continue to fuel the market in the long term. While the bull market will continue. I could see a bottom coming, temporary bottom coming in, you know, sometime in October. I think we'll get a I think this will turn into a 5% pullback for the S&P, if not more. But yeah, I agree. I don't think we're not going to see like what we saw in early April, late March, early April, because that was, the whole tariff shock. That was when tariffs were new, and now market sort of has a handle on tariffs. So um, yeah, I agree with you that AI is tired, at least in the short term, is it from a narrative standpoint, at least.
One thing that Mike wrote about, I think, in his growth investor issue was uh, seeing acceleration, like a rate of change acceleration in the headline indexes. I think it hit like a 30% level or something like that. I don't have the exact numbers, so I won't drill down into it too much. But he said that the only other times that has occurred, 12 months later, the S&P on average was up like 17%.
Yeah.
Right. So that would be fantastic. The downside of course, is that we're coming off we're coming off two back-to-back 20% plus years. The market's already up 10, 12% this year. Right. We've already priced in a lot of good news. Um, and maybe we just take a breather and then we sort of revert to the mean and continue upward as Mike expects. But uh, we'll we'll just have to wait and see.
Yeah.
Um, I mean,
Yeah.
this is obviously a much different environment than I guess any other market condition that we've seen. Certainly since you and I have been investing or trading, right? Like,
Yeah.
does that undercut? Can we as reliably look back at like historical evidence if we're in an environment where we have a unitary executive that's just applying tariffs and changing trade policy and you know picking winners?
Yeah. Well, we'll get to that in the federal government investing portion. Let's move to one part of the market that has been working particularly well lately, and that's small caps. Since the start of August, so last 2 months, essentially the Russell 2000. It's not a perfect representation of small caps, but it is sort of the benchmark index for them, up 12.2%. which is almost exactly twice the gain in the S&P during that time. Talked to Tyler London, our small cap expert, the other day. Uh, I think he attributes a lot of it to anticipation of Fed rate cuts. Rate cuts, lower borrowing costs are even better for small cap companies. And, frankly, some of the tariffs in America first type policies don't hurt them as much because, a lot of small caps or smaller companies that do most of their business in America. They don't have, some of the same concerns with, tariffs hurting their business, like something like, Nike or Dick's Sporting Goods or something like that. Um, and so, I think, well, they've taken a little bit of a breather here, similar to the overall market in the last week or so. Um, he thinks earnings should be the best for small caps that they've been in a while. While large caps have posted double-digit earnings growth the last couple of quarters, small caps have lagged badly. And one other big thing that Tyler highlighted is that the valuation for small caps is much lower, which is not something you usually see historically, much lower than large caps. Like you said, large caps on a trailing basis trading at 30 times earnings, forward basis 23 and a half plus times earnings. Well, Russell 2000 small caps are trading, it's like 16 times.
Yeah.
So there's a lot going for small caps. That hasn't that hasn't always resulted in that's been the case for a while. I mean, the small cap index like just got back to um, record highs from a few years ago in the last couple months. Um, so we'll see. But the environment does seem ripe for small cap outperformance as it has done the last two months here.
Yeah, I mean, to that point, so just in the last 5 years, Russell 2000 high in 2021 and sort of the everything bubble um, was in November around
Hmm.
2437. This small caps got to that level again in November of last year,
Yep.
and just yesterday um, peaked above that level a little bit, but we're right near all-time highs,
Yeah.
whereas like all the large cap indexes are trading meaningfully above or at new all-time highs. Um,
Yeah, that mid 24s range has acted as resistance for the Russell 2000 for like 5 years, 4 years.
yeah, I would love a break above it. Like, I mean,
Yeah.
I'm in a tough environment where there's not a ton of room for growth. Like that's an uphill climb for small caps, but at the same time, that valuation discrepancy, like would I rather own large caps trading at 30 times trailing earnings that maybe grind a little bit lower or just don't move a lot, or would I rather own small caps at a more respectable trailing earnings figure with room to grow, and also knowing that the right small caps sort of in the right sectors or the right marketplace are going to benefit from certain policies, right?
Right.
Like if you are a small cap, I don't know, like engineering consulting firm or something like that, and there's a huge push to onshore manufacturing, you will probably do great. If you're predominantly involved in U.S. centric businesses, the therefore it affects your input costs, but it otherwise like you're not at a ton of risk there. That's exactly the kind of business that government policy are trying to support right now. Um, the lack of growth thing, like I would love for small caps to run up 30% while large caps take a breather. I don't think that's going to happen.
Right.
But like on balance, I would rather be more in small caps right now, just given the valuations and given maybe some limits to growth.
Yeah, I agree. I mean, as Tyler has said on here when he's come on here before, small caps historically outperform large caps like 3 out of every 5 years on average, and it's been more than 5 years since that's happened. Yeah,
And
given the combination valuation, it does seem like this is specifically a high interest rate phenomenon where, since the Fed went to high rates in the last few for the stocks, but their earnings. I mean, I guess those go hand in hand, obviously. So yeah, I like the bet on small caps right now.
yeah, a lot of small caps are financials. You've got like regional banks and stuff in there. And those benefit from lower short-term rates and higher long-term rates. They borrow short and lend long. Um, so if the Fed is is going through a rate cutting cycle as they've sort of started, and they appear on pace to do another one or two cuts by the end of the year. Um,
Mhm.
that improves spreads for small banks. Um, it improves the rates that small caps borrow at. The um, the SOFR rate, which replaced LIBOR, is the borrowing rate for a lot of variable rate debt. Small caps tend to have a high amount of variable rate debt relative to larger companies. Um, that tracks pretty well with the Fed funds rate. Where I think there's maybe a throttle is if the Fed's long-term projection, their 3-year projection with Fed funds rate at 3% through the end of the 28, if that holds true, um, that's going to be a governor on small cap growth a little bit. But rate cutting is good for small caps. It is still a an asset class that I like.
Yeah. Similar to small caps, a lot of these are small caps starting out. IPOs are having a good year, at least in terms of number of companies coming public. The number is up 56% year over year, which speaks to sort of a more growth appetite in the market. There's been some hesitancy. I guess it's sort of similar to what we've been talking about with all the money market fund, all the trillions of dollars in money market funds. What is it? Seven something or no, approaching seven.
It's like 7.8 right, 7.8 right now.
7, 8. Oh, right. You said you might your take that you thought it might get to 8 trillion by the end of the year might come true. Um,
Well,
the escalating amount of money on the sidelines in the form of money market funds has sort of been reflective of hesitancy about the market. But and IPOs have been down. There've been fewer stocks coming public. Well, that's changed this year. StubHub was the latest big name to come public in the last week. Um, yeah, it's funny. I guess this is just we've been talking about how AI has, lifted all boats lately, and I don't have a breakdown of how many IP of these IPO names are think they have an AI foothold, but I would guess it's a good percentage. But I think this just shows, third year of a bull market that has expanded to be more inclusive, little less top heavy, at least until recently. Um, yeah, I guess this is just a reflective of more risk on appetite in the market this year.
yeah, I think so. 198 filings as of a week and a half ago. It's up 28.6% from the prior year. First day gains for IPOs this year have averaged 26%. You mentioned StubHub came public at like 2350. They fell about 10%. So people weren't super stoked to buy StubHub.
May not have been the
Um,
right week to come public in StubHub's case.
yeah, and the ticket broker thing, I think Live Nation had just gotten sued or had just settled or something along those lines for some of their extra fees that they were applying.
Yeah.
BlackRock Coffee Bar caught my eye just because my wife loves it. They were up like 20, what? They were up 37% first day of trading. Now they're up 25%. Figma was a big one that is AI centric. They IPO'd at 33. They closed at 115 the first day. So huge run up, but they're also down like 60% since then. They're trading at 52.46 right now. So they're down 55%. Um,
Yep.
the other element to the IPO thing is also private equity needing to realize cash. If they're funneling money into these new AI startups that are not profitable or that need maybe a longer runway, you take some of your backbenchers, these other companies that maybe better established, and you push them to come public so you can generate some liquidity and get some returns for these longer investments. Um, I don't know that it's necessarily a bad thing that they're forcing some of these companies public. I mean, right now, I don't know if it's come up on this podcast, but there are more ETFs in the market than there are individual companies right now. Um,
Yep.
Private equity has been sitting on a ton of names. It's just not accessible for individual investors. So seeing some growth in the IPO market, I think overall is a net positive.
Yeah.
The exact motivator for which companies are going IPO when, like the AI thing, obviously, strike while the iron's hot, maximize value, get whatever you can. Some of the other companies that maybe aren't in ideal positions, but are feeling the impetus to get moving and to get to the market. It's not like a green flag, but it's not a red flag either. It's just like, okay, well, maybe those aren't companies to invest in. But I
Yeah.
think the net it's a positive for the market.
Right. Yeah. Like I said, it sort of signals that the market is more risk on this year. In terms of investing in IPOs, it's just, just sort of strategy. I think you and I are aligned where I'm not big on investing in IPOs right when they come public. I think, Tyler's talked about, waiting for lockup expirations, which is usually 3, 4 months after the company comes public, because there's a lockup period for any company that comes public, which means that the company insiders, executives, um, can't sell their shares until usually 3, 4 months after the company's come public. It prevents them from just booking profits right away, or if things go bad, selling out right away. Um, so usually that there's usually this sort of mass exodus or exodus of some kind once that happens, and then after that it sort of can just exist on its own merits. So I usually waiting a few months for this, not only for the stock to sort of tell you what it is, maybe have an earnings report come out, but also for for that lockup expiration to come and go. I think is a good way to approach it. At least that's how I like to approach it.
Yeah, it gets some of that volatility out of the way,
Yeah.
certainly. I mean, one of the difficult things with IPOs is that if they're highly sought after, everybody wants them. If you can get them as part of the initial offering, that's fantastic. I mean, we just talked about Figma that priced at 33, started trading at 115. If you got an allocation from Figma's IPO, you tripled your money just from getting selected by the underwriter to get some shares. The problem is you probably put in for 1,000 shares and got 75 or 200. Um,
Yeah.
Everybody is rushing into these companies that they want, and then because of that, there's not like a lot of sustainable buying pressure because if it's a phenomenal IPO, everyone's like, well, I sort of missed the boat on that one. Oh, well, I'll look for the next one. And if it's poorly received and trades lower, uh, there's nobody's in a rush to get into them. So it's like, okay, well, I like the company. I'll wait for lockup expiration. I'll wait for the first earnings report, something like that. I mean, my beloved Portillo's sandwich company,
Oh
which
yeah.
IPO'd a couple of years ago, had like a flat IPO and has just ground lower ever since.
Hmm.
Um, so just because
They
you
have
love the,
those out there. I didn't. Yeah, I didn't really. I feel like it was
oh yeah,
just all Tex-Mex out there.
no, we have a diverse array of foods available to us.
Yeah.
Um,
We have
Portillo,
a diverse array of farm to table here. Uh,
uh, Portillo's, they IPO'd back in the everything bubble at 38. They're at $6 a share right now, and they've just been grinding lower ever since. So like a lot of IPOs, companies that you maybe individually are looking forward to or excited about, if they land flat and and you just sort of wait, you can find yourself waiting for a really long time. I
yeah.
have, never bought that stock. I probably never will, and I hope they don't go bankrupt. I'll spend my money on Italian beefs and hot dogs instead.
Yeah, I've always seen that. I don't think I've ever had it, but always intrigued me, Portillo's.
Oh, it's good. It's good. It's not great for the waistline though. But that is just an example of what can sort of go wrong if you have like an IPO that then doesn't collapse but just doesn't do anything. You just never get the investor interest.
Right.
Um, if it's a highly sought after IPO and you can get the IPO, yeah, do it. Go for it. One of the problems, if you are an individual investor and you get the IPO allocation, a lot of brokers will blacklist you from IPOs if you immediately dump your shares
Yep.
because the underwriters don't want a bunch of selling pressure. Well, partially because they can't sell, they can only backstop and buy more. So that might be a one-time use thing for you if you get the next hot IPO and you go and dump it right away.
Well, speaking of IPOs, small caps, at least sort of, and we've invoked Tyler London's name here a couple times in the last 10 minutes. Our offer today is for Tyler's Cabot Early Opportunities Investment Advisory. If you go to cabotwealth.com/street, you get 50% off the normal price for just $497 for the year, and you get a 30-day 100% money back guarantee. So if you want to try it out for a month, you can cancel anytime. But it is a service that where Tyler recommends five new stocks every month. And while Tyler is a small cap expert, they're not the early opportunities is sort of more all encompassing, where it's not just small caps. It's sometimes he's recommended mega cap tech stocks that are at the beginning of a new opportunity, including one at the beginning of this, right at the beginning of the AI cycle a couple of years ago that's done phenomenally well. It's there, so the early opportunities sort of has a more broad meaning where it could be well-established stock or company that has a new opportunity that's going to, potentially send shares much higher. So yeah, five new stock picks every month. Tyler gives regular alerts on, buy, sell, hold alerts on his stocks that he's recommended. You get a free special report, Secrets to Early Stage Stock Profits, and you get access to Tyler via email. He's good at answering everyone's questions. Again, go to cabotwealth.com/street and you get 50% off the normal price if you want to sign up for Cabot Early Opportunities. Okay. This was something we didn't get a chance to talk about last week. It's a little bit older news, although it keeps changing. Um, Intel is been in the news a lot. What's the expression? It takes a village to raise a child. It seems like it takes a village to raise Intel these days. They're now being everyone has a stake in Intel. Nvidia, with a $5 billion investment. Federal government now has a 10% stake. That's something we'll get to more of. Apple, I don't think details are finalized there, but Apple supposedly is getting a piece of the pie, and now Taiwan Semiconductor. What's going on here? Why Intel?
SoftBank has a $2 billion investment there. Apple and Taiwan Semi have been approached, and this was even prior to the government taking a stake. The so Intel ran up 22.8%, 2 weeks ago, the day
Yep.
that it was announced that Nvidia invested $5 billion at 23.28 a share. So Nvidia has picked up a cool $3 billion in the couple of weeks since. One note, this was pretty widespread, at least in the financial media. I'm going to read a quote from Wolf Research from Chris Caso or Casso. I don't know the pronunciation. What's unclear is whether this represents token cooperation intended for political purposes, or if it's the start of a wider collaboration that would more significantly benefit Intel. By all accounts, and I think this is reinforced with some news that came out last night, investing in Intel seems to be more a political play than an economic play. $5
Yes.
billion is a lot of money, but it is a token amount of money for Nvidia. And it's not like Nvidia contracted Intel's fabs. They just said, yeah, we'll buy your chips to put in our servers. You work on some specialized chips that are going to go with all this hundreds of billions of dollars of server farm infrastructure and we'll kick 5 billion your way and we'll buy up some stock. Last night, I believe on Truth Social, the president said that if you is pushing for a sort of a one for one rule for semiconductors to avoid tariffs, where if you sell if you sell 2 million semiconductors and a million of them are made in the US, you can import the other million. So it's not a bad way to try and incentivize the manufacturing. The problem is the timing behind it. I'm not far from the Taiwan semi plant in Arizona. It's taken like 5 years to get that up to the point where it's actually producing chips. Um, Intel has some chip expertise, but not the stuff that's the most in demand. Apple, I think, obviously is potentially a pretty big partner because they need chips for smart devices. And Intel can't do the GPUs that Nvidia does, but they can do the chips that Apple is currently getting from Taiwan Semi. So I wouldn't be surprised. Apple's already given the president the gold iPhone trophy or whatever. I wouldn't be surprised to see them sort of take more of a stake there. It's incentivizing domestic manufacturing. It's just sloppy and half considered. Uh, but yeah, it seems to be a political play, but that might be the market that we're in now.
Well, yeah, let's just shift to that broader discussion. We're used to seeing, deals between the Nvidias and Intels and Apples of the world. That's something we're used to seeing. Deals between companies. What we're not used to seeing is federal government investment. Cliff Droke in his Cabot turnaround letter issue this morning had just put it in as plain of terms as possible, saying as the dividing line between the public and private sectors becomes increasingly blurred, it's readily apparent that long-term investment decisions must now be evaluated through a new lens, and that means asking a simple question: could the financial asset I'm interested in acquiring be potentially influenced through direct federal intervention? The answer to that question is, of course, more complex and demanding than a simple yes or no can provide. But he goes on, but the fact that we have to answer, I mean, first of all, how can you spot something that the federal government would have interest in? Now, Tesla, Elon Musk taking a place on in Trump's cabinet, that one was obvious, and that's why Tesla ran up a bunch at the end of last year. But yeah, how much do we need to factor this in? Are there any other plays that you see coming down the pipeline that could have federal government intervention? What is your take?
We you 100% need to factor this into any investment decision you make.
Yeah,
I think Cliff said it really well. I had not heard that.
yeah,
I asked you to say it for the podcast because I was very curious what his assessment was. And I think he's right. Um, we had talked when the US government took a position in MP materials,
yeah,
I'd mentioned like quadruple U as a potential beneficiary. But the government has not taken a stake in them, despite, they're probably a double since then. I'll toot my own horn for a second, but there was a lot of speculation that they were going to be buying a position in Lithium Americas.
yep,
Um, LAC is ticker symbol is they're down 15% today, but they're up 95.5% in the last week. Uh, there, I think there's a lens that you can look at this through. One is protectionist policies. So what companies are going to benefit from, even if the even if the buildings don't go up, contracts for more U.S. manufacturing, shipbuilders, what there were new tariffs applied to like trucks being imported. So I think there are some real economy stocks that will be beneficiaries of this. Where it gets tricky is, what if you just pick the wrong horse? What if
right.
I what if I pick company A and they're the best looking construction aggregate provider in the country, but the federal government opts to go with company B because company B said something nice about the White House. If you pick the wrong horse, you just lose. I would say thematic ETFs, sector ETFs would be a decent way to play it. The president, I mean, all of this ultimately is coming down from the president, right? Like the
Yeah.
president wants to look like a winner and he wants everybody to see that he has picked winners. So you will see the forces and the spending decisions and the regulatory decisions of the federal government twisted in a way that is going to make whatever his sort of thought process or whatever winner he's picked look the best. Um, I'm not a mind reader. I don't know the best way to anticipate that, but I would say pay attention to the things he's saying when it's like, hey, we're gonna manufacture stuff in America. We're gonna trade less. Yeah, okay, take him at his word on that front. Um, I mean, Intel is I think a good case in point. They've been struggling for years because their fabs are bad because they can't deliver the high quality chips that the marketplace is demanding. And that's why Taiwan Semi has been building in the US and why they've continued to grow because Taiwan Semi can. If I had to pick a chip name, I would have picked Taiwan Semi over Intel, but federal government picked Intel because it's US owned and does all their manufacturing in the US.
Well, yeah, that's why I wonder how much of a tail these federal government investments have. Like as you just mentioned, you just cited, I mean, Intel has pulled back some since that. Now, granted, they've had all these other investments, but since the federal government got involved and the stock shot up, the Lithium Americas rumors, sent that stock way up, and then it's pulled, as you said, pulling back 15% today. Like, I wonder, like, should Intel, if Intel is a inferior or makes inferior products to Taiwan Semiconductor, but the US government is now involved in Intel, does that make, after the initial fervor, does that make Intel a better intermediate to longer term investment? I don't know.
I think it probably depends on the nature of the agreements.
Yeah.
Because the other factor is that the president doesn't seem to care about the long tail effects of these investments. The president cares about the optics of announcing a brand new deal for Intel.
Yeah.
Um, I think, I mean, this is maybe a little bit tongue in cheek. The companies that looked great in the 70s, right? Like that, like that's, it seems like that's what we're trying to, I mean, when they announced the tariffs on imported furniture
Yeah.
and trucking manufacturing. It's like, well, trucking is critical for the US, but the it's not the driving force for our multi-trillion dollar economy. It's very important, and we should probably have like a domestic truck manufacturer. But so I don't know, buy bell bottom stocks. Who makes bell bottoms now? Does Levi's? Actually, now that I say it out loud, yeah, maybe buy Levi, right?
Yeah.
We there's a ton of fast fashion out there. All that stuff comes from Vietnam and China and Indonesia. I don't know how much Levi even makes in the US anymore, but I feel like some throwback names that used to be manufacturing powerhouses are probably the way to go. Maybe Boeing. I could see the US government taking a stake in Boeing.
Yeah.
Um, That's not a bad idea. Some of the GE names,
Hmm.
uh, domestic, like Rolls-Royce isn't going to be the beneficiary of protectionist trade policies, and they make all the jet engines, but like GE Aerospace might be.
Yeah.
Um, I think those are sort of the names to look for. And I haven't done a deep dive on thematic ETFs, but that seems like a better way to try and play a focus on any particular sector. Otherwise, you're just you're just picking racehorses at that point. It's like, yeah, maybe this is the one. Okay, well, we don't know.
And yeah, Lithium Americas is a good example. We talked about how earlier about how small caps could benefit in a couple of ways, from lower interest rates, but also from the new sort of America First policies, since they do most of their business in America, Lithium Americas is a small cap, $1.5 billion market cap, and that's obviously way up from what it was this time a week ago. So I wonder if small caps could benefit there too, if there might be more smaller um, US based, companies that do all their business in the US that could, you know, be in line for federal government investment. I don't know. It's hard to, as you said, it's hard to pick winners here, but it's something to be conscious of, as as Cliff noted. Something you have to factor in that in a way that haven't really had to factor in for
They're
decades, our entire lifetime. I don't know.
certainly not our lifetime. I
Yeah,
will say, all of these in hindsight have been really well telegraphed.
yeah,
The president complains about shipbuilding, and shipbuilding stocks do well. The president threatened months ago that, or promised months ago that we would see pharmaceutical costs slashed to near nothing, and that he would apply tariffs for pharmaceutical manufacturing. And lo and behold, news breaks that it's 100% tariffs on pharmaceutical imports, but not if you have plans to build a facility in the US. So like all of the major pharma manufacturers, companies like your Eli Lilly's, that already have plans in place. Now, keep in mind these facilities take multiple years to build,
yeah,
but they're all doing fine. They're not selling off on the news of pharmaceutical tariffs. Right now, Lilly is they're up 1% or eight tenths of a percent, nine tenths of a percent on news of 100% tariffs because they're sort of skating by. So I guess pay more attention to the president is what I'm saying. Like, I don't want to be recommending that to anybody, but
more
here we
attention.
are. Yeah.
Yeah, yeah. I mean, when it comes to investment, um, things that could be in line for federal investment. Yes, for sure. And
Yeah.
that's
If he starts airing grievances about a specific sector or industry, and it's like something that he's hitting periodically, then look at plays that would benefit from protectionist policies of that industry.
yeah.
That I mean, that seems like the most practical way to play it. Um, Automakers next. I don't know.
Yeah, we'll see. It's hard to guess. But yeah, something to pay attention to. Um, well, on that fun note, I think that's a podcast. Yeah, there was a lot to catch up on this week. So we went long with Larry Chung last week. Thanks everyone for joining us. As always, like and subscribe, give us a 5-star rating. Have any questions, email us at streetcheck@cabotwealth.com. Anything else I forgot before we sign off?
D D-backs sliding out of the playoff race, and it's not
Yeah,
going to make it.
yeah, they seem like they hung in there for a while, but yeah, I'm looking. Well, yeah, it's good to start and finish a podcast with Arizona sports teams.
Yeah, it's universally applicable, and everybody's interested.
Exactly. Okay, thanks for joining us, and we'll talk to you again next week.